Let's take you now to the Governor of the RBA after today's rate rise.
And to increase the interest rate paid on exchange settlement balances from 0% to 25 basis points. It also decided to not reinvest the proceeds of the government bonds as they mature over coming years. These decisions reflect a judgment by the board that it is now time to begin withdrawing some of the extraordinary monetary policy support that was put in place to help the Australian economy during the pandemic. Two considerations are particularly relevant here. The first is that the economy has been very resilient. Unemployment is low and economic growth is expected to be strong this year. The second is that inflation has picked up more quickly and to a higher level than we had expected, and there is now evidence that labour costs are increasing more quickly. In these circumstances, the board judged that it was now appropriate to start the process of normalising monetary policy in Australia. I acknowledge that the increase in interest rates comes earlier than the guidance that the bank was providing during the dark days of the pandemic. During that period, and especially in 2020, the national health situation was precarious, the economic outlook was dire, and it was clouded by a lot of uncertainty. The board wanted to do everything it could in those circumstances to help get the country through that difficult period. In those unprecedented times, we judged that the economic damage from the pandemic was likely to require that interest rates remain low in Australia for years. As things have turned out, though, the economy has been much more resilient than we had expected, which is clearly very welcome news. The combination of fiscal and monetary support has worked, and the development of vaccines in record times has allowed our society to return to more normal functioning more quickly than we had expected. Australians have also proven to be resilient, and we have adapted well to our changed circumstances. As a result of these developments, unemployment now stands at 4%. It's expected to decline over the rest of this year to around 3.5% at the end of the year and into next year. If so, that would be the lowest rate in almost 50 years. It's a remarkable achievement. Labour force participation has also risen to a record high, and a higher share of the working age population has a job today than ever before. The economy is also expected to grow strongly this year, with the Reserve Bank's central forecast being for GDP growth of a little above 4% this year. This resilience of the economy means that the record low interest rates are no longer required. The other major development has been on the inflation front. Over the year to the March quarter, CPI inflation was 5.1%, and in underlying terms, inflation was 3.7%. These numbers are lower than the inflation rates in most other advanced economies, but they are higher than we have experienced for many years, and they are higher than we were expecting. The main driver of the higher inflation has been global developments, with a series of major global supply shocks pushing prices up over the past year. The pandemic has interrupted supply chains, and it continues to do so with the recent lockdowns in some of the large Chinese cities, again disrupting production and transport. And on top of this, Russia's invasion of Ukraine has resulted in sharp increases in the price of oil and gas, of base metals, and of many agricultural commodities. Inevitably, these shocks to global prices do flow through into higher inflation in Australia. But the higher inflation outcomes have a domestic component as well. There are a number of areas where strong demand is now putting pressure on available capacity, with many firms reporting that it's quite difficult to hire workers with the right skills. This pressure on capacity is reflected in the broadening of the areas in which prices are rising more quickly than they have over recent years. Firms in a range of industries are now indicating that they are prepared to pass on cost increases through into higher consumer prices.